Right, good morning everyone, and welcome to this update. We need to discuss SARS Draft guide on the taxation of crypto assets. I say we need to, honestly, it's really just a rehash of the capital versus revenue rules. I mean, if you know how the CGT system works and you know the definition of gross income, then nothing here should be new. But it is useful in a sense that it does give us an idea as to how SARS sees particular crypto transactions. So insofar as the guide sets out the capital versus revenue rules, who cares, right? It's not new. But at least what they do is they apply the basic principles to particular crypto transactions. And what I'm going to do is I'm just going to summarize, just give you a summary of what SARS is saying in their draft guide. Bear in mind, it's a draft guide. It's open for public comment. My name is Nico. I studied some tax and I like doing tax. All right. This training is intended for my staff. For those of you joining online, it's just purely for your interest's sake. It's designed and intended and relied upon by my staff. The main message that I take from SARS's guide, and I think that you guys should take from it, and if you fall off the training from this point on, I completely understand it. But the point is that crypto assets do not receive special tax treatment, right? SARS applies, and correctly so in my mind, the ordinary income tax and CGT principles. The main dividing line or the main distinction in the tax treatment depends on whether the gain you make on a crypto transaction is capital or revenue, right? So what the guide does do is, like I said before, is it takes particular crypto transactions like barter transactions, fiat swaps, or crypto to fiat swaps, crypto to pay assets, staking, hard forks, those sorts of things, and they apply the basic rules to determine what the gains might be. So I suppose it is useful to some degree. Right. The starting point to understanding the tax treatment of cryptos is that it's just an asset. A crypto is an asset, it's an intangible asset, but it's an asset nevertheless. It's not currency, it's not foreign currency, it's not shares, it's not equity shares. It is included in the definition of financial instrument, right? But the point is this is ultimately, the crypto is a intangible asset that you can either hold and deal with on capital account, or you can deal with it on revenue account. And of course, you must consider each transaction to determine what the consequences are. The importance regarding the characterization of the crypto as not being, shares, for example, is, for example, that the 9C equities 3-year equity rule, automatic capital rule doesn't apply. 24I doesn't apply. The weighted average method of determining the base cost of identical assets don't apply because crypto exchanges aren't recognized exchanges for the purposes of the 8th schedule. So that's important to take note of. Right. What they do is they take this transaction by transaction approach in their guide, and they also say that when you look at the tax treatment or trying to determine the tax treatment of these crypto transactions, you must look at each transaction on its own and determine on its own merits and on its own facts what is the tax treatment, revenue or capital. Of course, that has got a bearing on base cost and trading stock deductibility as well. So although we are concerned about the revenue gain or the gain, the tax treatment, whether that's on revenue or capital, but also the nature of the asset and how you deal with it also determines its tax deductibility. If it's trading stock, we're subject to Section 22. If it's CGT, we're subject to the 8th schedule in determining the base cost. Right, let's see where they go into the specific crypto type transactions. They don't cover all types of crypto transactions, but I think they cover a broad spectrum. We've dealt with crypto tax issues on both sides of the coin that we deal with, which is disputes, where we're disputing with SARS the capital versus revenue treatment, and in VDP, where we've just gone and VDP things, and really this is the principles that we apply. Right, so, and this is the principles that come up in disputes as well. So if you sell a crypto for fiat currency, the taxpayer sells a crypto asset for Rand. The sale may happen through a local exchange, foreign exchange wallet. The taxpayer becomes entitled to fiat currency. The transaction is a disposal of a crypto asset. And on that basis alone, we must say, okay, fine. Well, if we have an asset that we're selling, we must determine whether or not the proceeds are included in gross income or whether it's a capital gain or a capital loss. If it's a revenue gain, the cost of the crypto asset may be deductible under 11A, subject, of course, to the closing stock and opening stock provisions of Section 22. If they were held on capital account, And then, of course, you'll have a CGT. And, of course, if the amount that you receive for the sale of your cryptocurrencies is foreign currency, then you must use 25D and 43 of the H schedule as applicable to translate that foreign currency into Rand, or that capital gain into Rand. Right, that's pretty straightforward. I think most of the taxpayers out there understand that if you sell a crypto asset for fiat currency, that's a tax event. The question of whether it's capital revenue is very fact specific. SARS is very adamant about the frequency of the transaction. If you are going to have a high frequency of buying cryptos and selling them, of course, that indicates a profit-making scheme, or a profit designedly sought and worked for. You cross the Rubicon, then of course they're going to say that, look, this is a profit-making scheme, and so the gains are taxable on revenue account. But then, of course, the expenses are deductible. And bear in mind that the idea with taxes is unless you're registered for the turnover tax for some reason, but you don't pay tax on turnover. I had a client a couple of weeks ago that came in here with having made a bunch of money on gambling, and the question is, well, what about the expenses? Yes, we can have the debate about whether or not, because it's the same kind of question. Capital versus revenue. Is it? Have you embarked on a profit-making scheme? Let's say, assume you did. Okay, fine. Then we must get the expenses, because you don't pay tax on turnover. You pay tax on your taxable income, which is after deductible expenses. Right. So just bear in mind that, of course, high frequency is indicative of an intent to trade. Can I just ask my admin team to mute whoever it is who's speaking, please? What SARS points out is they say, look, you might have the intention of trading in these cryptos, buying and selling them for the purpose of using the money to retire. That doesn't make it capital. The question is whether or not you've embarked on a profit-making scheme. That's the question. Right. 5-year holding period does not automatically convert the crypto into capital gain. If the crypto was bought to realize a profit later, SARS may still treat the gain as revenue. So the old principles of intent on acquisition, intent over holding, and intent on sale is really the driving factors. If there is no golden rule test, but that is the kind of the line that spans through all the case law is intention. Right. Inherited crypto assets. Well, look, I mean, if you inherit a crypto asset, it depends on what you do with the thing and whether you sell it in a profit-making scheme, right? But of course, the inheritance of the asset will set a cost for it in terms of the applicable rules for CGT. But if you sell the thing, the result is that the proceeds are most likely going to be capital in nature, unless for some reason you embark in some way of trying to increase the profits. It's possible or most likely to be on capital account. If you keep a crypto asset for the purpose of selling, it becomes part of trading stock, right? And trading stock, for those of you who are familiar with the normal tax treatment of trading stock, will know that your deduction for trading stock is permitted under 11A, but subject to the reversals in closing stock in Section 22, and then the deduction again in opening stock in the next year. So one must bear in mind that if you've got cryptos that you're buying and selling, or they're buying for the purpose of selling, and you're doing this frequently, it becomes a trade, and then unfortunately for you, the provisions of Section 22 kick in. Good luck keeping track of those cryptos. Right. Here's one of the biggest myths I think that still exists out there that SARS's guide deals with fairly quickly and correctly so in my view, is if you are exchanging one crypto for another, that's a tax event. There's nothing strange about that. It is not unique to cryptos that SARS wants to tax that. If I sell my services in exchange for a car, I still am rendering a service, and the car's value is going to be included in my gross income, right? That is a normal barter transaction, right? And the same applies to cryptos. If you're going to swap one Bitcoin for Ripple, for example, that is a barter transaction and is a tax event. There's no need for the transaction to be cashed out into fiat before it becomes taxable, contrary to popular belief, right? And that still seems to be, lots of people still think you have to cash it into fiat before it becomes taxable. Right, SARS treats swaps as a barter transaction that the taxpayer disposes of the crypto asset given up and acquires the new crypto asset. The proceeds on the disposal of the one given up is generally equal to the proceeds for the purpose of calculating the gain or the loss, is equal to the market value of the crypto asset received. And the cost of the new crypto asset is generally the cost of the asset given up, right, in determining the tax treatment. The point again, crypto tax or the tax on crypto gains is not deferred until the asset is given up in exchange for fiat. That is important, right? And one must bear in mind how the cost elements track the crypto transactions from either a trading stock or a CGT point of view. Right, if you use crypto to buy goods or services, SARS makes the point that you must bear in mind that really this is exactly the same as a barter transaction. You are either paying in cash, you're selling the asset, the crypto asset, in exchange for a service or a good, or it's first exchanged into fiat and then you pay with the fiat currency. It depends on what the transaction is, but the point is it is a tax event. And the tax event will be triggered at the point in time that you use crypto assets to buy goods and services. And indeed, there's going to be a cost element to the acquisition of the asset. And one must bear in mind, okay, so I'm selling an asset, which will have a proceeds, and then I'm buying an asset at the same time. And one must determine if the net effect will be a net zero, because I might sell the asset on revenue account to acquire an asset on capital account, which means you don't get the 11A, it goes to base cost, right, of the new asset. But if it's a revenue for revenue transaction, you should, in theory, break even, assuming, of course, the asset is worth the service being given. So the point is for now, the point I want to make is if you use crypto to pay, you must understand that that is a realization event and is a tax event, and one must determine what the tax consequences are, whether revenue or capital, right? And I think I don't want to go into too much detail into that. Employees being paid in crypto, this also seems to happen, right? Long story short, right? If you get crypto for services rendered, it's revenue, right? And SARS makes the point to say it's probably subject to PAYE, right? Because it's the value, it's an amount received in cash or otherwise, by virtue of or in respect of employment, and so therefore that will fall firmly within the definition of remuneration, and indeed perhaps potentially in the 8th schedule as well. If you give if we say it's an asset, you give the employee an asset for free. Well, you have to look at the 7th schedule, but there is prima facie, as SARS, if you're going to pay employees in cryptos, there is most likely an employee's tax obligation, right? Arbitrage transactions. For those who don't know, arbitrage exploits the price differences of the same crypto asset on different exchanges, right? And so what SARS says, and I've said this before to many taxpayers long before the guide, is when you understand the nature of arbitrage transactions or arbitrage, crypto arbitrage, it is designed as a profit-making scheme because you're exploiting the price differences. You are working hard to find those price differences and exploiting them. And nobody is saying you can't do that. All SARS is saying is that to them is certainly a transaction that they're going to tax on revenue account, because they say it's inherently profit-driven. And therefore you'll pay income tax on it, and the ordinary income tax principles would apply, bearing in mind cost of assets and the principles of trading stock, right? Mining, you see where this is going? Mining is the same thing. Not the same thing, I appreciate that it's an entirely different process, but the point is it is inherently profit-making driven. It is inherently an effort that you put in, designed, worked for effort. And SARS says, if you don't know what mining is, you can look at it there, look at SARS's guidance, but SARS says this is a trade, right? In their view, it's a trade, and it will be taxed accordingly on revenue account, and that to me makes sense. I'm sure there are instances where one might want to make arguments based on the very small nuances of each particular case, but the basic principle is you are employing an effort and skill and energy with the aim of making a profit, right? Mining deductions, one must be careful. Acquisition of mined crypto can be treated as a barter transaction of mining services for crypto, right? So the trading stock acquired through mining might have an 11A deduction subject to do 11A, and you might be able to add electricity and some computer equipment for wear and tear. In other words, if you're going to run a proper business, which mining is, then you're going to be entitled to the tax benefits, but you're also going to be regulated by the provisions that regulates normal trading activity. Which is unique to some extent in the context of mining. Staking, again, I read a paper of someone, I forget the guy's name now. It's unfortunate that I do. But staking is the same kind of principle, right? It is almost like you're earning interest for lending your, and I'm not going to pretend like I'm a crypto expert, right? But the basic principle of staking is you are putting your crypto back into the blockchain, and people can use it, and for that you earn staking rewards, is what they call it, which is, thank you, which is effectively interest, right, or similar. It's similar to interest in its nature. And SARS says that, look, if it's staking, their view is it's probably included in gross income, right? So it's a revenue transaction. Staking reward, SARS says it's revenue. DeFi transactions, they don't really say much about decentralized finance transactions. These are transactions that are, for example, derivatives, but built on blockchain, like for example, CFD derivatives, something similar in the crypto space, or swaps, or whatever the case might be. All these weird derivative instruments. You've got decentralized finance, derivative, and other sorts of transactions linked to crypto assets as well. And they don't really say much. They're saying that you have to look at the principles or each transaction and determine, with reference to the normal CGT versus revenue principles, what the transaction is going to be taxed like. Right, so that's really all they say in respect of DeFi transactions. An airdrop, this is becoming repetitive, but that's what they say. An airdrop, they say, look, you can either work for an airdrop or you can get one as a gift. And if you worked for it, right, then you have received something of a revenue nature for services rendered, and it's taxable. If it's fortuitous, you got it as a gift, well, then the airdrop is a capital receipt, right, in the hands of the recipient. Right, that's fairly straightforward. The cost of the asset in the case of airdrops, I'm not going to go into that. Hard forks, the same applies to a hard fork, right? A hard fork is where you've got a crypto, I'm going to explain it as best as I understand it. A blockchain might end, right? Or a protocol might end and they issue a new one. So you've got the old crypto and then the new crypto that's regulated by a new set of rules. And the question is, okay, how do I treat this new crypto that I received? For the most part, if it's not worked, well, if it's not designed and worked for, it's a gratuitous receipt. Right? So that new crypto asset won't have a revenue income tax consequence. It would be a fortuitous receipt. But if it is worked for, then it's going to be a revenue receipt. Right. Long story short, and this is the bottom line across the entire guide, whether it's revenue or capital will depend on the facts. Right, I'm not going to go through this cost of the assets. Donations, this is something that happens often, but if you receive a crypto as a gift, of course, you must appreciate that what you're doing is you're donating, or someone is donating to you an asset. And if you don't pay for that asset, or if it's a gratuitous disposition, right? So let's say it's a common law donation, a gratuitous benevolent disposition of an asset, so there's no form of quid pro quo, then it's going to be subject to donations tax. Or if you sell the asset at less than arm's length value, it could also be a deemed donation. And I'll take questions now. I see there's a question from Gloria. I'll take questions now at the end of the session. But if it's a donation of a crypto asset, then SARS will impose donations tax according to the normal rules, 20% or 25% for donations above 30 million. Remember, the donor and the donee is jointly and severally liable, right? And bear in mind that these transactions, staking, crypto swaps, crypto to fiat transactions, crypto to buy assets, these tax events can take place throughout the year. They'll need to be declared ultimately on your final income tax return, but they obviously have a bearing on provisional tax returns as well. We're now in August, so we know the end of August is first provisional. If you are into crypto trading, chances are you are a provisional taxpayer, and you must ensure that you pay your tax on the crypto transactions through the provisional tax system, which is not a session on its own. I think SARS has got an interpretation note on provisional tax. I think it's interpretation note 2 or 1. I stand to be corrected, so you can read. I'm not going to lecture on provisional tax. Record keeping, unfortunately, you must keep records. And this is something that we've realized, especially in the initial stages of crypto, because we're dealing with some transactions, some disputes going back many, many years, and VDPs going back many, many years. And I know that record keeping or the availability of records is an issue, especially some of the exchanges closed down. Unfortunately, that is a real risk. And the message I think that I will give you now going forward, and so far as you can going backwards, is keep as many records as you can. Of course, nowadays there's platforms where you can pull the data and it will consolidate all the data, which is something that some of my clients use. I'm not going to pretend like I'm an expert in these things, but I'm not even going to mention the software. but there are software out there that you can use to consolidate your transactions, but you need to keep records. And remember, this whole approach where people would say, yeah, but SARS must come and prove this, that SARS doesn't carry the burden of proof. It's an entirely misconceived notion. You carry the burden of proof. So if SARS comes to you and they'll say, well, this is the money in your bank account, you prove to me that it's not taxable, or that it's the capital receipt, if you want to say it's capital, or that there's a deduction against it. And for that, you're going to need record keeping. So not only are you obliged by legislation to keep records, it'll serve you well if you are going to go through the objection appeal process, because you bear the burden of proof, right? Disclosure and SARS's visibility. All I'm going to say on this is, because I've said a lot on it already, is they can see the crypto transactions, right? The crypto asset reporting framework was adopted earlier this year, which is an international movement by revenue authorities around the world. And the basic premise is that the crypto exchanges, or certain reporting institutions like exchanges, must tell SARS about your crypto transactions, right? In the same way that your employer must tell SARS about what you earn as a salary, in the same way the bank must tell SARS what you're earning in interest, the same way now these exchanges, mostly local and some foreign exchanges with a local nexus, have to report to SARS about your crypto transactions. So they know about it, right? And whilst it doesn't extend, our domestic law does not extend to all foreign exchanges, for example, the same basic principle is being adopted, the crypto asset reporting framework, in other jurisdictions, which means that if there's a South African who earns crypto that's must be reported to HMRC, for example, in the UK, and HMRC must tell SARS about it. So the reality is SARS has great visibility. Not only SARS, HMRC, all the other revenue authorities, or many of them, have greater visibility over these crypto transactions, and so the risk of detection, as we call it, is extremely high. And here, for me, is a message in the timing of SARS's release of this draft guide, because the crypto asset reporting framework was adopted, I think, in March or April this year, right? The first reporting period is only for February 27, right? So the reporting period doesn't include February 26, right? So SARS adopts this international framework into law in South African domestic law, and then a couple of months later they release a guide in which they tell you this is how we tax, or we think particular transactions should be taxed, right? And now the way I look at this is they're saying to you, listen, we've told you that we know about it. We've now also told you how to deal with the tax. We've given you a guide, albeit it's draft and subject to public comment. But my take on it is that if you then still go and you fail to disclose, I think that non-disclosure will be met with quite some harsh penalties. And the reality is there is no excuse, and most certainly I deal with the flip side of defending taxpayers against SARS as well. The other side, of course, is the voluntary disclosure program, where you go and disclose voluntarily. They are aggressive with penalties, and it is not an easy fight to fight them on these penalties. And the tax is the tax regardless. And I think that given this greater visibility that we've got over cryptos, and we've got filing season that's now open as well. Again, I don't think the timing is a coincidence, right? Adopt the crypto asset reporting framework in April, publish it publicly, media release. Then publish a draft guide, media release. Filing season is also open at roughly the same time. So one might be inclined, and I think that would be the right position, of course, and I must in fact suggest that you do that, or say that you do that, is that you disclose your crypto assets in this year's tax return. But the risk for me that I want to highlight for taxpayers is, if you think that it is a good idea to simply draw a line in the sand, if you will, and simply declare the 2026 crypto gains and losses, when in fact there are gains and losses in earlier tax years, you're making a big mistake. The chances of a return being selected for verification if you declare crypto assets for the first time on this year's tax return, remember, it's not a difficult algorithm to run. Where all of a sudden did you get R1 million worth of assets on your balance sheet this year? It didn't happen in one go. It's possible. I'm not saying it's not impossible, but if you think, and I don't know how SARS algorithms run and their risk engines run, but my logical thinking is if you get R1 million worth of assets on your balance sheet all of a sudden this year, where did it come from? Audit, and then they extrapolate backwards. And once they flag it for audit, the VDP doors are closed, right? You can't VDP. So my take on this is I don't think the timing of SARS's release of their guides, of the guide and the adoption of the framework and the overlapping of that with e-filing season opening is coincidental. My suggestion is if you've got historic non-compliance, probably the best approach is to go through the VDP process, get that in, and then file your tax return for this year, right? In which you disclose whatever, when I say this year, I mean the 26th year, in which you then disclose whatever your gains or losses are on your cryptos, because it is not invisible. And the reality is this, I think this will stand up in the court. Right.